Hey everyone, thanks for joining me. I'm excited to get this started. I haven't done anything like this before, so hopefully it goes well. But luckily this problem this week isn't too difficult. So this problem is found in Chapter 4, homework number 1, problem number 5. And the problem goes as follows. Actually, before we get started, I want to go over just two definitions really quick. These definitions refer to different forms of basis of accounting that it's important to understand these bases. So the first we'll go over, the first one we're actually going to do is cash basis, and that's companies record revenue at the time they receive cash. So anytime a company receives cash or a payment, they'll record that. Anytime they spend it, they record it. So no matter when the service is done, whether it's already been completed or it hasn't been completed yet, they record everything that they receive for revenue, as well as anything they spend. They put that down as an expense, per se, at least according to this problem. So anything that they even though they might owe additional money, or it might have cost more, or they didn't use all of that expense, as long as they paid, they count it towards their accounting year. In the accrual-based accounting, the transactions that change a company's financial statements are recorded in the period in which the events occur. Sorry about the typo. Even if cash was not exchanged. So how this works is that, according to the accrual basis of accounting, is that once a service is completed, that's when they will record it in their ledger. So whether they receive payment or not, they're going to record that service as revenue received. It's the same thing as with expenses. So as soon as they know they're going to spend money, or they need expenses, the cost of an expense to do a project or perform a service or a good, they'll record that, just whether they have paid for it on credit or not, or paid for it in cash or not. So that's kind of the basis of the information that we need to understand, and then we'll walk through this problem. It's not too difficult. So this is the problem. So it talks about how in the first year of operations, Wild Horse Company recognizes $33,700 in service revenue, so the money that they received for performing their services, $7,800 of which is on account and still outstanding. So of that money, they still haven't been paid $7,800 for it at the end of the year. So the remaining $25,900 was received in cash from customers. So that is what they have been physically paid, or what they have, they've attained. The company incurred operating expenses of $19,400. So to perform the services or goods that they did for the past year, it cost them $19,400. And these expenses, of these expenses, $13,600 were paid in cash. So 13,000 of them were already paid for the company, meaning that 5,800 are still owed, bought on credit, right? However you want to think of that. So in addition to all of this information, the Wild Horse prepaid in cash $2,680 for insurance coverage that would not be used until the second year of operations. So they have prepaid, meaning this insurance has not been applied to the company in the previous year. Okay. So now that we have the basis, our first objective is to calculate the first year's net earnings under the cash basis of accounting and the first year's net earnings under the accrual basis of accounting. So this is really simple, especially for the cash. So any time that they spent or received cash, we record it. So the first thing we do is we know that although they've earned $33,700 and performed $33,700 in services, they've only received $25,900. Right? So we'll record that $25,900 in cash as their revenue for that year. Now expenses, we know that when we record expenses, these are deducted or taken away from the revenue to see what our income will be, or net income will be for a company. So the company incurred operating expenses of $19,400, but that they only paid $13,600 in cash. So we'll only record that $13,600. We're not going to do anything with that $5,800. Following this, we know that Wild Horse prepaid in cash. I didn't say cash, but we know that they paid for it, so we can assume it was in cash. $2,680 for insurance they have not used yet. Okay, and that brings their net income total to $9,620 for last year. That would be their net income. Now, for the accrual basis, what we're going to do is, although they haven't received full payment for the $33,700, because they have performed those services, we are going to count it towards our net income, or as our revenue. So on the accrual basis, we'll get $33,700. Now, what we're going to do down here is with the expenses, again, although we have only paid $13,600 in cash, we still owe money for it. We're actually going to include in the expenses everything that it cost for Wild Horse to perform their services for that year. So the $19,400. Following that, Wild Horse prepaid $2,680 for their insurance coverage that won't be used until the second year. So because the insurance is not used last year at all, we're not going to include it. So we're going to count that as 0. So the net income from, according to the accrual basis, is net $14,300. Now the last question that we have to completing this problem is what basis of accounting cash accrual provides more useful information to the decision makers. Now, for a few reasons, people might just want to pick the accrual basis because the number looks bigger, so that might look bigger for investors, people looking to make money. But the accrual basis is just more accurate, a record of what occurred last year, what the company actually did, as well as it's the same as the cash basis. If we just go off this, it's going to look less. It's not going to record all the information accurately of what occurred last year as well as the previous year with the insurance. We'll know next year what's going on, where this insurance money was coming from, or where it went to. So the accrual basis is just a better use. It's a better form of accounting. This is talked about in the textbooks, and actually it's accepted. This is pretty much the standard rule in the GAAP. So that is the question number 5 for this week. Hope it was helpful, and you guys have a nice evening.